Most likely, when you first began investing, you began with stocks. With a little more expertise under your belt, you may want to start diversifying and expanding your portfolio, as long as being established, a broad portfolio is the best way to reduce risk and increase returns. After all, diversifying your assets as an investor provides protection against market fluctuations, which is something that is becoming more and more crucial in today's society. Here are 6 ways you may enter the commodity trading market. Investing in commodities can be a significant way to diversify your portfolio beyond standard securities. But as a beginner investor, there are several ways to do so, each with certain advantages and pitfalls to take into account. Hello everyone and welcome to Finance Wisdom. In this video, we're going to talk about commodity trading for beginners English video. If you're new to this channel, do like and subscribe to the channel. Let's define commodities clearly first. Commodities are any uniform resources that are regarded as fundamental products, such as the grains that go into your cereal in the morning or the silver and copper found in the crude oil that is refined into the gasoline you use to power your car. Commodities come in different forms, but they all have the characteristics of being tangible in nature and traded on international marketplaces. Because of shifts in supply and demand, commodity prices often experience significant fluctuations. For instance, when a given crop has the largest harvest, the price often declines, and when there is a drought, prices frequently increase because of concern that the supply would decrease. Energy, cattle, and meat are the usual 4 basic categories into which metals are sold. Your decision on which category to invest essentially depends on your long-term objectives, since each has its own advantages and hazards. If you don't know what you're doing, trading in commodities may be a dangerous endeavor. It will be much more advantageous in the long run to learn the fundamentals of commodity trading for beginners English. Number 1. Invest directly in the commodity. There is no other way to participate in commodity trading if you wish to invest by physically purchasing a commodity except to make a direct investment in one. The fact that you can avoid using a middleman is one benefit. You may just search for a merchant to sell you a certain product. That dealer will often purchase it back from you when you no longer need it, but you'll need to arrange for delivery and storage beforehand. Additionally, if you're purchasing gold, the process can be a little easier. Online, it's simple to locate a coin trader who will sell you a bar or coin. You can securely keep it and sell it later as you choose. But it becomes much more challenging when attempting to arrange for the delivery and storage of bushels of maize or crude oil from cattle. Because of this, investment in the majority of physical commodities is often prohibitively time-consuming for individual investors. Number 2. Invest in commodity stocks. By purchasing stock and businesses engaged in the production of commodities, you may invest in commodities indirectly as well. You might, for instance, purchase mining stocks, agricultural stocks, or oil stocks. You may get into the oil industry by investing in British Petroleum, and you can get into various metal businesses by investing in Rio Tinto. In contrast to the basic real worth of commodities, the risks connected with commodity stocks often focus on the firms themselves, whose prices may be adversely affected by business operation or other company-related issues. This implies that a corporation that produces a commodity will always increase or decrease in tandem with the product it produces. An oil production business will undoubtedly profit from rising crude oil prices and suffer from falling ones. But what matters more is how much oil the company has in reserve and whether or not it has profitable supply agreements with customers that have a strong demand for oil. Although there isn't a way to totally eliminate this risk, investors may thoroughly investigate the company before buying stocks. Number 3. Invest in future contracts. A future contract is an additional entry point into commodity trading for beginners English. A futures contract is an official contract to purchase or sell a certain commodity at a fixed price at a given point in the future. Futures contracts need extensive market research to get started. Thus, novice investors are usually discouraged from doing so. The main reason is that speculative activities dominate futures investing. However, investors have the option of working with a broker or choosing contracts with a purchase option. Using futures contracts, traders wager on the direction of the commodity price. You would purchase futures if you believe the price would increase and sell futures if you believe the price would decline. Generally speaking, you're committing to purchasing X quantity of a specified product at a given future date. For instance, you may agree to purchase 10 tons of coffee 30 days after the deal is made. You are expecting that by that time, prices will have changed enough to allow you to make a profit. The fact that margin requirements for trading commodities are far lower than for equities presents one important danger. Margin trading involves using borrowed funds, which may increase your losses. Given the volatility of commodity prices, you must be prepared to meet any margin calls, which are occasions when your broker requests a larger deposit. The S&P 500 Index, the Dow Jones Industrial Average, the Nikkei 225, the FTSE 100 Index, and the DAX Performance Index are some of the most well-known futures markets. If you like this video, don't forget to like and subscribe to the channel. Let's continue to discuss commodity trading for beginners English. Number 4. Invest in commodity ETFs. It is advisable to explore commodities via ETFs if you have a good grasp of stock investing but little funds available for investment. Exchange-traded funds or ETFs let you trade commodities in a manner akin to stock and share trading. Similar to stocks, they may be purchased and sold and prices fluctuate all throughout the trading day. An online or conventional broker may assist investors who want to buy commodities ETFs in order to possibly benefit from changes in commodity prices without directly investing in future contracts. ETFs are a fantastic choice for people who are interested in shifting commodity prices. Since you may keep your ETF shares for as long as you choose and they don't expire after a certain amount of time, trading ETFs is also a fantastic method to get exposure to the commodities market with minimal risk. Before making an investment, be aware of some of the expenses related to trading ETFs or just ask your broker whether they provide demo ETF trading. Number 5 is to invest in mutual and index funds. As they operate differently from other kinds of commodity investments, mutual and index funds are excellent choices for novice investors as a first step into commodities. Although they don't trade on an exchange like mutual funds, these funds have the same liquidity as stocks. You typically work with a qualified fund manager when investing in commodities mutual funds. Just be aware that managed funds often have higher fees. With a managed account, you may invest across many commodities and sectors, providing quick diversification. Index funds, on the other hand, monitor a commodity's price throughout a trading day. Mutual funds don't watch the price throughout the day since they don't utilize an exchange. After the price is established, they wait until the end of the day to assess the commodity's worth. You gain from expert money management, increased diversity, and liquidity when you invest in these products. For investors looking to benefit from businesses that deal with commodities without directly purchasing equities, investing in mutual and index funds is a fantastic choice. Number 6 uses commodity pools for commodities. A group of investors may pool their funds to buy futures contracts and options by using pools. These individuals gather money from several investors to put into one fund, then invest it in a commodity or commodity basket if you don't yet have any expertise investing in commodities. The investors participating will get account statements and yearly financial reports. Along with managing your fund, your CBO will also keep track of who is investing, what they are investing in, and any transactions involving the pool. They could also base their investing choices on the changes in a given market. For example, they may assist you in keeping tabs on commodity prices and selecting the ones that are ideal for your portfolio. You have additional investment possibilities when you work with a CPO. They can make better bets with the pooled money since they oversee a group of investors which opens up additional options for commodity trading. The 6 approaches to investing in different commodities are as follows, gentlemen. Commodities are recognized to be dangerous investment opportunities because they may be impacted by unpredictabilities such as odd weather patterns, disease, and natural and man-made calamities that are difficult or impossible to predict. In general, investors with a sizable amount of wealth to spare and at least some expertise are best suited for commodities. The greatest way to mitigate risk is to include commodities in a diverse portfolio as opposed to placing all your eggs in one basket. Most people would be better served by commodity equities, mutual funds, or exchange-traded funds or ETFs if they were intending to invest in a commodity for the long term. We've reached the end of another video and thank you for watching. I hope you have learned commodity trading for beginners English. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.